Today, I'm going to talk about how to buy tax delinquent properties. I'm sure you've heard of tax delinquent properties, maybe you've heard of tax liens or tax deeds, but how does all of that work? Well, by the end of this video, I'm going to detail out for you exactly how to buy tax delinquent properties so you can utilize this awesome strategy to help you build wealth in your real estate investing career. When you think of tax delinquent properties, you got to understand you can put them in the category of a tax deed or a tax lien, but when you hear that, you might be thinking I'm speaking a different language. Have you ever wondered how investors make sense of those two different terms and utilize it to their advantage and incorporate it into a strategy where they're building tremendous wealth? Stick with me because we're going to dive into these topics exactly by first explaining what property taxes are and how they become delinquent. Next, I'm going to break down for you how to find these properties and finally what to do once you find them. If you're ready, let's go. So what are property taxes? Well, you got to understand that if you live in the United States, you're paying taxes on most things. You're paying taxes on the food that you eat, you're paying taxes on the income that you make, and yes, you're paying taxes on the property that you own. Property taxes really are just dues that are owed to the governing agency, and they take that money and they use it to build parks, schools, libraries, or other items that will benefit the community. And every single year, the taxing authority sends out what's called a tax assessment, where they give you what they value your property at and how much property taxes is owed on that piece of property at its current value. If property values continue to go up, obviously, how much property tax you owe will also go up. And there's a funny thing in the investment world where many investors want that assessment that comes from the taxing authority to be as low as possible, but obviously they want the value of the property to be as high as possible, so there's that discrepancy because the lower the assessment, the lower the property tax that you owe. But overall, property tax is just another added expense to that monthly payment of what your mortgage payment is, the insurance you owe on that property every single month, and the property tax. Combine those into a mortgage payment, and you're paying that to your mortgage company if it's a traditional mortgage, and typically that mortgage will pay out and disperse that insurance payment and the tax payment to the correct agencies or organizations. So how does a property become tax delinquent? Well, obviously it's when somebody isn't paying their property taxes. When they receive the bill in the mail and they just don't pay that, eventually that property is going to become delinquent. Now, the governing agency is going to send out a notice to say, hey, you owe this property tax. And if you don't pay it, they'll send out another one and send out another one till eventually they're going to put a lien on your property. Now, how long you have to where you don't have to make payments before the government takes your property, it really depends on the agency, on the county, on the state. There's a lot of factors that are involved there, but most cases, it's 1 to 3 years. The government's only going to wait so long before you're so delinquent on your property taxes that they're not going to take that property to auction to try and get their money from that. Ultimately, if you do not pay off your tax bill that's owed, the governing agency is going to sell that property to recoup it. And really, it's done in two different processes. There's something called a tax deed and a tax lien. A tax lien, if you're in a state that's a tax lien state, or if you're in a state that's in a tax deed state, you got to understand the difference between the two. Now, a tax lien, if a governing agency sells that tax lien to an investor, that investor is now the debtor, and they're trying to collect that debt from the person who owes the property tax. Right? And eventually they're able to foreclose on that debt and get the deed to the property or title to the property. If you're in a tax deed state and the governing agency sells that property as a tax deed, the investor who buys that owns the property, right? They get the deed and title to that property. So those are two different things. Both can eventually end up in owning the property, but if you're a tax lien state and you hold the tax lien, you are entitled to receive the debt from that with an interest rate, but eventually can foreclose on it and own the deed or title. Now understand, the government wants no business being in the real estate. They just want their money, right? That's why they're taking these lengths to go to auction to get their money. So it presents an awesome opportunity to investors that are able to acquire these properties, because I see tax delinquent properties growing every single month, every single year until the economy turns around. So how do you find these properties, right? There's a couple things that I do to find these properties and a couple websites I really like. The first free resource out there is a company called bid4assets.com. Bid, the number 4, assets.com. It breaks down by state, by county, and you're able to find some of these properties that are available or that are going to auction. It tells you the date they're going to auction and typically the starting bid. You can also just contact the local county assessor's office and find out if they're having an auction on any tax delinquent properties. Another way that I find these properties is through an off-market real estate property software called RealFlow. I love this software. It does cost money, but it's worth it. You can query and filter the software to spit out properties that are owed taxes, right? So tax delinquent properties you can find through the filters on this property. So once you find these properties, you find one, you find an auction you want to go to, how do you move forward at that point? So if you find yourself with a property you like and it's a tax lien property, you got to be able to move forward and purchase that tax lien. And there might be some time that it's going to take in order for you to actually acquire the deed or title of that property. But no, if you hold the tax lien, you're going to be making an interest on that money that you hold or that debt that's owed to you. And eventually, if it's collected, you're going to make that money or own the property outright. And obviously, with a tax deed sale, you can own the property outright, but you've got to be prepared to be able to purchase that property outright. But both of those options, whether it's a tax lien or tax deed, it's going to require that you have a certain knowledge of the market that you're in and make sure that you're not making a bad investment, that you're not overpaying or buying in an area that just is going downhill. The next thing you have to understand is that buying a property that is owed taxes is a slow process. It just doesn't happen quickly. Typically, you're going to have a few months before the auction to be able to familiarize yourself with the area and with the actual asset itself and the real estate market conditions. And that is vital time to be able to do your research because, so if you find a property that's going to auction and you have a few months before that auction actually happens, yes, you can do some due diligence to really make sure that you're going into this auction prepared with the right money, understanding the market, understanding the values of the home, understanding what might have to happen to the home that you're going to buy in order to get it presentable and be able to resell or rent out. Here are a couple things to know and understand if you're looking at tax delinquent properties. Understand that the property is probably going to get worse from the time that you buy to the time that you take possession. So understanding costs that go into maybe hiring a real estate attorney, maybe some closing costs or rehabilitation costs is going to be important to budget into your overall money that you're dumping into this property. Because you might buy the property for X amount, but there might be some on top of that that you need to put into some of these added expenses. So that needs to be factored into your overall investment strategy to make sure you're making the type of return that you're hoping to make. And the final thing is following through with your commitment, right? If you are the highest bidder, make sure that you are prepared financially, whether you have money on hand, whether you have a personal loan coming from a private investor or a bank that's going to allow you to purchase that property outright. Because when you are the winning bidder, you'll probably have to give some money right then and there, a cashier's check or a lump sum of cash, and you might have 1 or 2 days to pay off the balance, but you have to be prepared to be able to do this. Now understand, finding and buying tax delinquent properties is an amazing strategy, especially in today's market. But there's one that I've come up with in the last 12 months called Cashflow flipping, and it is probably the most dynamic way of getting cash flow every month as well as building wealth, and it's one that I'm doing right now. And if you're interested in this strategy, I've got a full video that it breaks this out completely and helps you understand this process so you can go out and do it right now. Just click on the video below. Thanks for stopping by. Have an amazing day.